What if I told you that one man's investment strategy has turned $10,000 into over $500 million over the past 60 years? That man is Warren Buffett. And today, we're diving deep into his 2025 portfolio to uncover the secrets behind his legendary success. By the end of this video, you'll understand exactly why the Oracle of Omaha continues to beat the market year after year. Hey everyone, and welcome back to the channel. I'm your host, and today we're breaking down Warren Buffett's portfolio as of 2025. With Berkshire Hathaway managing over $280 billion in equity investments, there's a lot we can learn from how Buffett allocates his money. So grab a notebook because we're about to uncover some serious investing wisdom. The big picture: concentration over diversification. Here's something that might surprise you. Nearly 66% of Buffett's entire portfolio is invested in just 5 stocks. While most financial advisors preach diversification, Buffett takes the opposite approach. As he famously said, wide diversification is only required when investors do not understand what they are doing. This concentrated approach has delivered Berkshire Hathaway an average annual return of 19.8% over almost 6 decades. That's not luck, that's strategy. The crown jewel: Apple Incorporated. Let's start with the elephant in the room, Apple. Despite trimming his position significantly, Apple still represents about 24% of Buffett's portfolio, worth approximately $59 billion. What's fascinating is that Buffett, who admits he's not tech-savvy, saw something special in Apple that many missed. He doesn't view Apple as a tech company, but rather as a consumer brand with an incredibly loyal customer base. The iPhone has created what Buffett calls an economic moat. Customers are so invested in the Apple ecosystem that switching costs are enormous. The dividend champions: American Express and Coca-Cola. Next up, we have 2 of Buffett's longest-held positions, American Express and Coca-Cola. These aren't just stocks to Buffett, they're cash-generating machines. Take Coca-Cola, for example. Buffett first bought shares in 1988, and today that investment generates over $816 million in annual dividends for Berkshire Hathaway. That's a yield of 2.8% on the current market value, but remember, Buffett's cost basis is much lower. This is the magic of time and compounding at work. American Express follows a similar pattern. It's a company with pricing power, strong brand recognition, and the ability to grow profits consistently over time. The financial fortress, Bank of America. Bank of America rounds out Buffett's top holdings, representing another significant chunk of the portfolio. What Buffett loves about well-run banks is their ability to profit from the fundamental need for financial services. As long as people and businesses need loans, deposits, and financial products, banks like Bank of America will have a role to play. What this teaches us about investing. So what can we regular investors learn from Buffett's approach? 3 key lessons stand out. First, invest in what you understand. Buffett doesn't buy companies because they're trendy, he buys them because he understands their business models and competitive advantages. Second, think like an owner, not a trader. When Buffett buys a stock, he's buying a piece of a business. He's not looking to flip it next month for a quick profit. Third, focus on quality over quantity. It's better to own a few exceptional companies than to spread yourself thin across dozens of mediocre ones. Warren Buffett's 2025 portfolio isn't just a collection of stocks. It's a masterclass in patient, value-oriented investing. While we can't all have access to Berkshire Hathaway's resources, we can certainly adopt Buffett's mindset. Buy great companies at reasonable prices, hold them for the long term, and let compound interest work its magic. What do you think of Buffett's concentrated approach? Would you be comfortable putting nearly a quarter of your portfolio in one stock like Apple? Let me know in the comments below, and don't forget to subscribe for more investing insights. Remember, investing is a marathon, not a sprint. So think long-term and happy investing.